Hello, I'm Professor Brian Boucher, and welcome back. In this video, we're going to continue our DuPont analysis look at the Plainview technology case. We've got a lot of ratios yet to go through, so let's get to it.
So let's continue our ratio analysis of the Plainview technology case by bringing back up the DuPont ratio analysis framework. And if you notice, I've added a couple boxes to what we had last time. So below return on sales, we can drill down even further and look at gross margin and expense ratios to see what specifically is driving the improvement in profitability. And for asset turnover, we can drill down into turnover ratios for individual assets and liabilities like receivables, inventory, payables, see if there's anything unusual going on with those ratios. First, what we're going to do is drill down further into the profit margin ratios. So here we're trying to answer the question of what are the drivers of profitability. Certainly not lack of profitability in Plainview's case, since they're highly profitable. Most of these ratios come straight from the common size income statement. So we have gross margin, which is gross profit, sales minus cost of goods sold, divided by sales. We have an SG&A to sales ratio, SG&A expense over sales. We do operating margin with operating income over sales. We have an interest expense to sales ratio and an effective tax rate, which is income taxes divided by pre-tax income.
Yes. We already saw all of these ratios on the common size income statement. Will the entire video be this repetitious?
No, it won't be that repetitious. I've got a lot of new stuff coming for you. But yes, we do take these ratios right from the common size income statement because when we're trying to understand drivers of profitability or return on sales, the best way to look at the ratios are as percents of sales.
So here are the profit margin ratios for Plainview Technology. I have repeated the definition of all the ratios at the bottom. So why don't you pause and take a look at these ratios and see what kind of things jump out at you.
So one thing that certainly leaps out at me is the steady and sustained increase in gross margin between 2009 and 2011. Does anyone have any theories for what could explain this increase in gross margin based on the facts of the case?
Maybe the shifts to customized products and to customers in new industries allow Plainview to charge a higher price.
And it would certainly help that one large customer does not have monopoly power over Plainview. Ironically, Plainview is probably afraid to charge the defense contractor a high price for fear of losing the business.
No, you have it all wrong. It is the shift to automation and the new technology that allowed Plainview to reduce its manufacturing costs, leading to a larger gross profit.
Those are all excellent theories. It could be something where Plainview is able to increase its price while keeping costs fairly constant. So moving into the new industries, providing a customized product, getting rid of the monopsony relationship with the customer. Monopsony is the opposite of a monopoly, where the customer has the power instead of the firm. Or it could have been on the cost side, where Plainview's charging roughly the same price, but their costs have come down through automation or new technology. We're going to need to gather more information to see if we can figure out whether this is a price effect or a cost effect. So looking at the rest of the ratios, we see that the SG&A to sales ratio is completely flat over this period. So that means as Plainview has grown substantially, it's managed to keep its selling and administrative costs in line. It hasn't allowed them to grow faster than the growth of the company. Operating margin has grown over this period. That's primarily driven or exclusively driven by the increase in gross margin. And then there's not much really going on with the interest expense to sales or the effective tax rate over these three periods, other than a slight blip in effective tax rate a couple years ago.
Could it not be the case that a flat trend in SG&A would be bad news? If there were economies of scale, we might expect the SG&A to sales ratio to go down.
That's an excellent point, Elizabeth. We often look at trends and ratios, and if we see not much going on, we just think not much is going on. But it really could be the case where if Plainview has consciously done things to try to reduce their selling and administrative expenses as they grow, like say automating their receivable collection function, then it actually could be bad news for this to be steady as opposed to dropping as a percent of sales. So it really has to do with, do we have any information that Plainview's been trying to do something to drive this ratio down? And if they have, then this would be bad news. But lacking that information, I guess we would assume this is probably good news, that they at least haven't let their SG&A costs get out of control as they've expanded the firm.
So our profit margin analysis raises some questions that we need to dig into further. We see that gross margin is the big driver of Plainview's success, drove their increase in return on sales, which drove their return on assets, which drove their return on equity. But we don't know whether it was due to reducing production costs while maintaining sales price. So, was it the automation that was helping them? Or was it raising sales price while keeping costs fairly constant? So did entry into new markets allow a higher markup? So going to customized product into new industries? Or was it some combination of both? We can't drill down further into the income statement anymore, so we have to go elsewhere. We have to search for confirming or disconfirming evidence of these explanations in other parts of the statement. And of course, if we're the analysts having the call, we have access to asking management questions where we could ask very specific questions about what the source of their improvement in gross margin was.
That's it? Can't the ratios tell us more? I still don't know the answer to how they made their sales more profitable.
I can't promise that we'll ever know for sure just by looking at ratios, but I do have some more ratios for us to look at.
One place that we can look for more information to try to figure out what's going on with Plainview is to do an asset turnover analysis. Now, we saw earlier on that the asset turnover ratio is pretty steady over the period, but looking at the detailed components of that ratio could provide us some further insight into how Plainview managed its turnaround. For instance, companies that have dramatic increases in sales are often accompanied by lower inventory levels, so production can barely keep up with sales, so our inventory tends to go down, and higher accounts receivable levels as the company has to extend credit to riskier customers or give more generous terms to help try to fuel that sales growth. And if you recall earlier when we looked at the statements, we did see some weird things happening with receivables and inventory, so we're going to do a formal analysis of that coming up now. So asset turnover ratios are answering the question, how many times during the year do we cycle through the accounts? So for instance, an inventory turnover ratio of 8 would mean that we build and then sell the inventory 8 times during the year on average. So we're going to define accounts receivable turnover as sales divided by average accounts receivable. Inventory turnover is going to be cost of goods sold divided by average inventory. We use COGS here because if you remember from last week, COGS is tied to inventory, right? What comes out of the inventory goes into cost of goods sold. Accounts payable turnover is going to be purchases divided by average accounts payable. Again, if you remember last week, accounts payable are created anytime we're purchasing new inventory. We calculate purchases by taking ending inventory plus COGS minus the beginning inventory. So we get the new inventory that we acquired. And then finally, there's a fixed asset turnover ratio, which is sales over average property, plant, and equipment. Here's what the asset turnover ratios look like for Plainview. So why don't you pause the video and take a look at what these are telling you.
I do not find these turnover ratios very intuitive. I mean, accounts receivable turns over 6 times. What's that? That's about 60 days on average. Could we think about it that way?
Yes, I've never found these ratios that intuitive either. For example, going from 6 to 8 means that you're collecting your receivables more quickly because they turn over more times during the year. So I actually don't want to look at these ratios at all, but I want to recast them in a way that's more intuitive to me and hopefully will be more intuitive to you as well.
So now we're going to look at these same ratios from a different perspective. We're going to turn them around into what are called days outstanding ratios. These ratios are going to ask the question, how many days on average are the accounts outstanding? So if we see a days inventory ratio of 45, it means that it takes 45 days on average from the time we start building the inventory, so when we get the raw materials in the plant, until we finally sell the inventory. And I just find these much more intuitive, so we're going to spend our time in analyzing these ratios. So the first one is days receivable outstanding or days sales outstanding. If you've ever heard anybody talk about DSO in a financial statement context, they're probably talking about this ratio, days sales outstanding. It's 365 divided by asset turnover. And as you can see with days inventory and days payable, it's just 365 divided by the turnover ratios that we saw earlier. Then we're going to talk about something called the net trade cycle, which is if you add days receivable plus days inventory and subtract days payable, it gives you the number of days that you have a gap between cash outflows and cash inflows. And that gap represents days that you have to go out and bridge with short-term borrowing. And we'll talk about this ratio more in the context of Plainview. So here are the days outstanding ratios for Plainview. So pause the video, take a look at this, and see what you notice from these ratios.
So let's start on the top line with days receivable. That's gone from 60 days in 2009 down to 44 days in 2011. The 44 days means that from the time Plainview makes a sale, it takes about 44 days on average until they collect from customers. So it's gone down about 16 days over these 2 years. Now, is that good news or bad news? Well, remember from the first video, ratios are not inherently good news or bad news. It's what activity they reflect, and is that activity good news or bad news? For example, this would be good news if we've put in new collection efforts that allow us to get cash from our customers more quickly. But it would be bad news if we restricted our sales growth to only sell to customers that were better credits, and so we were getting our cash faster, but our sales growth was lagging. Now, that's clearly not the case for Plainview because their sales growth has been going up substantially. So what do you think is going on with this decrease in days receivable?
Clearly, it is the loss of the defense contractor that allowed Plainview to collect more quickly. Such a large customer can practically dictate its payment terms.
Maybe Plainview offered discounts for customers that paid more quickly.
Or, it was the improvement in the economy. After the financial crisis ended, customers had better financial health and were better able to pay on time.
Those are all great theories. Let's talk about them one by one. So Elizabeth suggested it was getting rid of the defense contractor that had the power over us, allowed us to collect more quickly. That could make sense where if you have one big customer, they can almost dictate their terms to you. Once you lose them, you could be more choosy with your customers to try to find ones that pay more quickly. I think one thing I'd want to look at is what are the normal payment terms for companies that deal with the new industries that Plainview's moved into, the nuclear power and the financial services and the healthcare. Eric's theory was that we're offering discounts to our customers to pay more quickly. The problem with that theory is if we offer discounts, it would affect our selling price negatively and it would cut into our gross margin, whereas for Plainview, we've seen a dramatic increase in gross margin. And Dave just thought it was the economy as a whole. Well, we can take a look at that. Let me bring up a comparison of Plainview to 3 of its competitors. And as you can see here, the change in accounts receivable, days receivable, is not shared by the whole industry. It's specific to Plainview. So my guess is it's probably losing the defense contractor and moving into the new industries that explain the improvement in days receivable. Next, we have days inventory, which has gone from 81 days in 2009 to 105 days in 2011, which means from the first moment we get raw materials, it's 105 days before we sell the inventory. So we're holding inventory 24 days longer. Is that good news or bad news? Again, it depends on what it reflects. It would be bad news if it meant our inventory wasn't selling. Probably not the case given our growth in sales. Be good news if we're increasing inventory in expectation of future sales. But based on the facts of the case, what do you think could be explaining this?
I think it was a shift to customization. It takes longer to produce inventory when it is made in customized small batches.
Yes, that would make sense with a higher gross margin. Plainview can charge more for our product because it is customized and takes longer to produce.
But it is peculiar that Plainview holds inventory longer when its sales are growing so much, and it built optimized new plants on the coasts to be closer to its customers.
I really like the customization theory. If we're making a lot of customized orders, small batch orders for our customers, they should take longer to make. We'll have to hold inventory longer. And presumably we get paid for it through a higher markup for the customization, which would explain the gross margin. But I also recognize Elizabeth's point that it is strange to see days inventory grow when your sales growth is going up so much. One thing that could explain that in this case is, remember, Plainview opened 2 new factories. And it could be that they want to run those factories at full capacity even if their sales aren't there yet. So maybe they're overproducing a little bit, and they can have inventory grow with sales growth because they've got the 2 new plants. There's one other theory that I want to throw out there, which is all of these numbers are based on 2 balance sheet points of view, 2 balance sheet points, beginning and ending of the year. What would happen if there was a big snowstorm that delayed an inventory delivery, say 10 or 15 days, right around year end? That could lead to a one-time blip in this. So always have to be careful not to draw too big of conclusions based on these ratios, because they are based on only a couple points in time. Now let's look at days payable. That's gone down from 55 days in 2009 to 33 days in 2011. That 33 days represents that from the day we get raw materials from our supplier, it's 33 days before we pay them the cash that they're owed. So we're paying our suppliers 22 days more quickly over this period. What could explain this?
No duh. Collect cash faster from customers, pay suppliers more quickly.
If Plainview pays suppliers more quickly, it might get to take advantage of discounts, which would reduce inventory costs and improve gross margin. Hey, this is fun.
Yeah, it could be a simple matter that if we collect cash from customers more quickly, we can pay our suppliers more quickly as well. And if that allows us to take advantage of discounts, as Eric pointed out, what that'll do is reduce our cost of raw materials, reduce our cost of goods sold, and help our gross margin. So this is another potential explanation for our gross margin. But there is a downside to paying our payables more quickly, and that's in this next ratio, the net trade cycle. So the net trade cycle represents basically how many days you have to borrow from a bank to meet your cash obligations. So we've got days receivable plus days inventory. What that represents is the number of days from when you get raw materials to you actually collect cash from customers. Because first you get raw materials, you have to turn it in inventory and sell it. That's our days inventory. Then once you sell it, you have to wait another 44 days to actually collect the cash. In the meantime, you have days payable reducing this, because once you get the raw materials, you can take 33 days to pay your payables. But that leaves us a gap of 116 days between cash out to our supplier and cash in from our customers. That 116 days, we need to go to other sources of financing like short-term bank loans. So over this period, Plainview is basically borrowing an extra 30 days of outstanding debt from the bank so that they can pay their payables more quickly.
This is very odd. Why would Plainview pay its suppliers more quickly when it would have to turn around and borrow more money from the bank?
You're right. This would only make sense if the discounts that you get from paying your payables more quickly are greater than the extra interest you have to pay by borrowing money from the bank longer. Now, presumably that's the case for Plainview, and in fact, we saw earlier that their interest expense as a percent of sales really hasn't gone up. So either they've been able to get lower cost financing, making it easier for them to take advantage of these discounts, or they've been using some of their equity financing to bridge this gap. In any case, it does seem to make sense for Plainview to pay earlier and get these discounts to help out their gross margin, because they're not taking on higher interest expense as a result.
So what do we see from this DuPont analysis? Overall, it looks like the entry into new markets is producing higher margin sales with faster collections, but longer production times. It seems like we're getting at least paid a higher margin to have the inventory in our factory longer. But there's some puzzles out there. So how were they able to pull this off with more than 40% sales growth per year? And why is their cash from operations so volatile, or I guess as we said earlier, squirrely? And so at this point, we have a pretty good idea of what's going on with Plainview, but that pretty good idea is going to now lead us to go ask better questions. We still don't know for sure all of the things that's happened to Plainview over these past 3 years just by looking at the financial statements and the ratios.
So, can you tell us what happened?
No, I'm not going to tell you. Because if you were doing a ratio analysis in real life, you wouldn't end it by knowing the correct answer, whether you were right or wrong. There's always going to be some uncertainty. Ratio analysis is not about the answer, it's about the journey. It's about using these ratios to try to learn more about what the company's doing, and more importantly, generate a set of questions so that you can test out some of your theories and gather more information about what's going on at the company. So I'm going to leave you hanging here. Just like in real life, you would go through, you'd learn all these things about the company, and then you'd have to go from there and gather more information. You're not going to get the answer right away in real life, and I'm not going to give you the answer right here. So we have just one more video to do on Plainview technology. We haven't looked at any of the liquidity ratios yet, so we'll introduce liquidity ratios and take a look at those ratios for Plainview technology in the next video. I'll see you then.
See you next video.